We welcome in David Dietze, Chief Investment Strategist, Dietze Wealth Management Group. Great to see you, David. I haven't seen you in a while. How have you been feeling about the markets? We were just saying, even with all the recent volatility, the S&P's, 2.5% off the highs? Nothing to fret about just yet. What do you say?
Yeah, so great to be with you again, Nicole. So it's been a volatile week here, and I do think that the number one issue is investors reassessing the AI trade. And there's some good reasons why people are really coming to grips with whether there is a bubble, whether we've gone too far. You've got a blue chip name like Oracle, which has lost 1/3 of its value since August. That's not like Oracle. You know, you've got like Meta down nearly 20% in just the last month. And that's, I think, causing investors to say, hey, what's going on? And then, of course, you have Michael Burry at the start of the week saying he's shorting AI. You've got the leader of Softbank saying he sold out of Nvidia completely. CoreWeave disappointed. And so I think a lot of people are starting to rethink, you know, how much capital expenditures are being made here? When will the payoff occur? And how much will that payoff be? And so we've seen a lot of volatility here. But of course, these stocks have gotten a bounce this morning and today.
And it's interesting because every dip people buy, they just do. And I will say for a name like Nvidia, for example, we had multiple price target hikes. I saw Wells Fargo put a 265, Morgan Stanley had a 220. You know, Dan Ives is out talking about opportunities. People are still stepping in and buying tech. I know they may be concerned about the AI bubble or the circular funding that's happening and the debt that's accruing too, particularly for Meta. We heard from Meta, you know, their capital structure has changed a little bit. You know, is it something to worry about? Are you worried? Are you staying away from tech?
So we're taking a very cautious approach here. I think we're doing what a lot of people have done, which is taking our profits there and rebalancing. One of the problems, of course, is close to 40% of all the S&P 500 in terms of the market cap is focused in these top 10 big AI related stocks. And so if you take money off and underweight, you do that at your peril in case, of course, the AI and tech stocks keep going. But again, to have so much allocated to such a small area of the market is nerve wracking. I think right now, all eyes are going to be on what does Nvidia report next week. If the problem is if they just beat expectations, and it may not be enough to carry us through year end, they may have to beat the so-called whisper numbers. We're starting to see, for example, Applied Materials last night had, I thought, decent earnings, but they didn't quite get to where so many investors were secretly hoping for them to be. And when you have everything so fully valued and expectations so high, there's going to be volatility.
I had a guest today say how Jensen Huang recently talked about data center revenue in the future will outpace the estimates. That sounded pretty positive, and I don't know if I didn't actually hear Jensen Huang say that, but that could mean something good for the earnings next week. But so goes Nvidia, so goes the market next week.
Yeah, I think that's right. And of course, as much as I admire Nvidia and Jensen Huang, I mean, you know, they sell to the data centers their chips, of course. So they have a vested interest in, you know, keeping the momentum up and making sure that they're not pouring any cold water on their potential customers. What scares me is the epicenter, of course, of AI is OpenAI. And, you know, they have what, 20, 30 billion in terms of revenues, but the amount of spending is going into the hundreds of billions of dollars. And the question is, you know, how ultimately will that debt, all those expenditures really be repaid and won and when? Of course, the longer they project out, the hazier it really gets. No one's got a crystal ball. And when everything is priced to perfection, that's when there could be some disappointment.
Let's get to some of your picks here. I know you have Kraft Heinz. Why Kraft Heinz? And how long have you liked this name?
Yes, it's just a cheap stock. I mean, I've been interested in it for a decade when Warren Buffett first got involved. Of course, he's been very disappointed with that stock going down 50% since he's owned it. That does not include some nice, healthy dividends. But now you're heading to a situation where all the consumer staples companies are so out of fare. There's concerns about the strength of the consumer. There's concerns about inflation in raw ingredients and so forth. And of course, when you have AI going gangbusters, why do you need processed food companies? But having said that, at this point, you got to be 11% free cash flow yield. You got a 6.4% dividend. What are the wild cards here? The wild card is one, they're going to split up into two companies. That may unlock value. But I think the biggest wild card is Mr. Buffett still owns 27%. What's he going to do? I don't think he can settle at this point with the stock down. So maybe he or maybe some other activist comes in and takes over the company. Certainly the cash flows are such that it could be a very profitable investment for someone.
And then we turn our attention over to energy. You're talking about SLB, formerly Schlumberger, as oil sitting around $60 a barrel. Where do you think oil's headed and why SLB?
Well, certainly, we're seeing that the geopolitical risks are still out there. We saw that Ukraine, nailed a installation in Russia. That's pushed prices up. I think Iraq commandeered a boat in the Strait of Hormuz. So your geopolitical risks are still there. Energy has done recently better as tech has slid. So, for example, SLB is up 11% the last month when the S&P 500 is flat. Why do I like SLB? It's a pick and shovel play, but one of the best in terms of oil field services. But what people are not seeing is that they're also a leader in the digital, the use of digital technology to extract more oil. They have a nice acquisition just happened with Champion X, 3.2% dividend, 12 times earnings. It used to be well over 20 times earnings. So I think there's a bargain here, and it's starting to move up here over the last month.
Last but not least, Molina Healthcare, MOH. Like a lot of the healthcare names, or this is a standout?
So it's down 46% year to date. So you certainly would be buying low, but it's part of the group with United Healthcare. And you've got these health insurance companies. Basically, it's the problem that a lot of insurance companies have from time to time where the claims, the cost goes higher faster than the premiums that they've been charging. And of course, you know what they do there, then eventually the premiums start going back up. No one's going to go without health insurance. Molina is a big player in terms of government insurance, whether that be Medicaid, Medicare, or the state market, the marketplaces run by the states and so forth. And right now, there's a bit of a mismatch. They should only make about $14 this year, but we see them ultimately going to $20 to $25 a share as they boost premiums up and investors come back to the health insurance area.
When we think about the big picture and what the Fed needs to worry about for the next meeting, you did talk about weakness in the labor market. In fact, you talked about it slowing and mentioned some of the layoffs. At the same time, are you worried about inflation rearing its head? What do you think the Fed does? What do you think the Fed should do?
Yeah, so I think the Fed cuts. I think that's a minority opinion right now. Just today, it went from a coin toss to, around 40%, and a month ago it was about 95%. Here's the problem. The Federal Reserve is working with no data. And so we're all speculating as to what, in fact, the true unemployment rate is, what the true inflation rate is. People worry about what the Fed is likely to do and stocks go up and down. I'm afraid that the Fed's going to be looking at the stock market to get a clue as to what's going on out there. At the end of the day, those members of the Fed who back in September and earlier in the fall said that there would be another cut in December, they really haven't backed off that. There's been some other naysayers that have put doubt into the marketplace as to what the Fed might do. But my best guess is, again, there is weakness in the labor market, Verizon laying off 20,000 people, things like that. And so I think they're going to err on the side of caution because of the risk to jobs. And that's going to be a more important factor than inflation and not disappoint people during a key holiday season.
I look at the 10-year bond yield at 4.14. We've been in somewhat of a range, and I say this, it's not like I watch it every second, but I'd say over the last 2 weeks, the range was just below 4%, 398, and the highest that I saw with my own eyes was 4.14, and we're back up there. What does that mean? Where do you see rates?
Yeah, so I think the rates have ticked up a little bit because actually first of all, the shutdown has ended. So some of the worst case scenarios in terms of a real slowdown in the U.S. economy have been avoided. That's going to be a little bit more, put a little bit more demand for money in the system. You've seen the stock market basically do pretty well. And so therefore, that also is keeping a bid under the 10-year Treasury. So at the end of the day, I think that a 10-year Treasury above 4 actually is a positive for the market. It's showing that the 10-year Treasury is not saying the big R word, the recession ahead of us. And although we do think that the unemployment situation is deteriorating a little bit, it's not falling off a cliff. And so therefore, we're reasonably happy with where the 10-year Treasury is today.
again, look, I saw your notes on tariffs. Basically, you like that the administration is focusing on affordability and working with Latin America, for example, to bring down prices for coffee and bananas, and whether or not there may be more tariffs that come down or get reduced or lowered. So, and also affordability on housing. I mean, they've even floated the idea of a 50-year mortgage. David Dietze will continue to talk in the future. Chief Investment Strategist, Dietze Wealth Management. Always great to see you, David.